How are you? Enzo DiCostanzo, clinical professor of economics and finance, St. Peter's University, Jersey City, New Jersey, coming to you from our studios here in Newark, as usual in the North Ward. We're going to get ready to do the Excel part of the investments chapter, and I'm doing some thinking. Sure, statement of cash flows is a good topic, and it's something that we should go over. But also, there was some very good economic news today, and I'm just trying to think if it might be better served to just go over some of that material type thing. Some of the bigger issues, the labor numbers. We added like 2 million jobs today, folks. So that's pretty good. And considering all the things, I mean, that it's May, it's just, but March was all the virus, this, the virus, that. We got through April, May, we added about 2 million jobs. Sure, the net numbers are way down. There's no question about that, but it's the right direction. And as my homeboy Trump says, this is just the beginning. And I'm a big believer in a lot of things that he says and does. I'm not trying to indoctrinate anybody's thinking, and you guys, everybody have their own opinion. My job is not to tell you how to think politically. I'm a big believer in that. But just look at talk about leadership. I lived in New York City, before Giuliani was mayor, after Giuliani was mayor, after Giuliani Bloomberg, which New York City had a very good 20 years public safety wise, with really brought it back from the brink. Watch a movie from the 70s about what New York City looked like, in the 1970s and the South Bronx and places like that. And what that looked like. That was something else. And for Julie, and I'll tell you, and I was talking to a cousin about this. If you take the train lines that go up to Boston, they go through Connecticut and Westchester. I forget what line it is, but the line that goes through Connecticut, I think it's Hartford or New Haven. All the Swiss banks have built, substantial assets, substantial office space up there, because I think they thought after living through the 70s and the early 80s, or most of the 80s, they didn't have confidence that you're going to bring in, $1 billion client and you're going to be in New York City, and it may not be the experience that you want to woo someone to invest $1 billion with you or something like that. So that's sort of what what was happening at the time. Giuliani made it safer. Believe me, he made it better for the Harlems, and they're better off because of him, not worse off. And that's you have to look at the reality. They have job centers up there. That a girl I dated, who works in one of them. I mean, the effort and there's a couple of them. There's in Brooklyn, Queens, Harlem. There's a few of them that really are, if you went to, if somebody obviously, not so much for the St. Peter's crowd, but if you had some trouble in your life, you're down, you maybe been to prison or something, and that's not an easy person to hire, and for better or worse. And they would really try to help them as best they can in a very Jesuit way, very Jesuit way. And you got to look at the facts. You got to look at this. Somebody screaming in the street, may not be the person to listen to about what's going on. Like I said, and the system wins. The system added 2 million jobs. That's the, so we might spend a little bit of time, this summer on that. But I look at the cash flow section, and now we're going to look at the investment section also, and we're going to go through I'm going to try to do just one big long Excel discussion tonight. If it takes 2 hours, it might be that length. And I'm saying you can pause the video. You can say, hey, let me watch it for 45 minutes, go have dinner, come back, whatever, see what Giuliani's saying on Fox News. And then, you can always do, you can circle around, you can schedule that yourselves. Well, folks, please watch the videos, and everyone's not watching. I see the number of clicks. I know how many people are in class. I give these to my family, and I know they click on them. So, and I click on them. So, it can't be 2 people watching them. It can't. Folks, you got to watch these videos. Okay. And you got to put the Excel right next to what you're doing, and watch the videos and go back and forth as best you can. It's like a cooking, remember the cooking was big 20, again, you guys are all 20, so, but a long time, like 20 years ago, the cooking was very big. There was Emeril Lagasse was on TV. He's that guy from Boston, who cooks very, Louisiana style cooking. And I forget who Bobby Flay was very sort of, everything had peppers, everything was peppers and tomatoes and grilled chicken with him, and lime and that kind of a thing. I forget, there's a bunch, there's like 10 or 12 of them that were, 20 of, and they're like 202, 203, 204. Rachel Ray, she's still around today. She's in the Oprah network. See, Oprah, what did Oprah Winfrey do? Because Rachel Ray's a good cook. She is. I'm not saying she's not, but people watched. You know, people watched her on some public access television station in Buffalo, New York, or Syracuse, New York, or whatever it was, and Oprah said, people watch her. And now she's on. That's. I hope for you guys. You know, yeah, I know. You know, Rutgers, all these different places. Yeah, with the online resume and this. I know all that, but you got to go make your mark. You know, you got to go out in the world and try to figure out. You got to network. You got to get to know people. And I'll tell you, with YouTube, with you guys make do whatever thing you want to do. You could do it on the computer and send, especially the videos. You can send it to people, and they get some sense of you. And I really want to encourage you to work that way, because it's going to help you. You know, and like I said, we live in a time where, and I'll tell you, the system spoke volumes today. All the unrest and all the problems in the parks and this and that, and 2 million jobs. The system wins, and that ain't bad. Okay, that's not a bad thing. It's not a bad thing at all. You can't, look, I do what I do I'm lucky. I do something that I really love to do for a living with you guys, and certainly my time at Rutgers and the different things that I do. I really enjoyed it, and I felt very blessed that I was early in my life, and I want that for you guys too. The very early, I wasn't 35 and said, oh, let me just go be a college professor. I was my early 20s, 23, 24, those kinds of ages, actually 22. Yeah, I was 22 when I started. Yeah, because I was at Marymount in '93. Yeah, I was 22. So, I want that for you guys early. Start early and be comfortable with what you do. I think that's the biggest part of things. Like I said, folks, let's get to the Excel. I notched up the Zoom based on what you guys. I got a couple comments from you guys. You wanted it to be a little bit bigger, so I made it 150%, and hopefully that helps. See, with Zoom. See, I see what what Google Meet does. There's too much of me on the screen, and it says that little corner that Zoom did was fine, but Zoom's not a very big company. So I'm sort of hitching my wagon to the Google Meet thing, and maybe it's my operating system or something that also is making it making it not work as well for Zoom as it does for Google Meet. And Google Meet is probably just simply a more robust system, but. There's my pictures are too. I try to even knock it off at all. Totally, that didn't seem to want to work. So I still have to. There's still some things I need to figure out what's going on. But folks, please keep having the homeworks come in, and the tougher ones. Okay, I see most people handed in both sets of definitions. Now work on the self test, and the last video I had the self test 15. Not this video, but the video after this will have the self test 16. You got to spend the time. Okay, you got to spend the time doing the stuff. Okay, so please do that. Let's present now and get going here. Okay, here we are. Okay, and you can still see. So again, I made this a little bit bigger because again, based on what you guys, and like I said, I was using actually YouTube's direct go live software. Also, I'm on my 3rd version of video, just doing this in a couple of years. So that's just we all need to get used to working like that. But 140% seems to be fine now. 150 because there's enough of my sort of window on the screen, which I don't really like. I'd be happy with a postage stamp version of me, and most of it being Excel. But what are we going to do? So okay, so let's look at this again. Investments. And I think the first question across the board is companies with extra cash. What do they do with it? Yeah, and Warren Buffett always tells the joke that if he's got extra money, he'll buy an airline, and he needs someone to stop him. Airline acquisition anonymous, because they generally they're not the financial performance can be very I don't want to say cyclical, but it can be very volatile, and you have big price swings in the prices of those. You could be sitting next to somebody who you could have paid 2 or 3 times the person sitting next to you paid for a ticket. And that's volatile when there's that much differences in the service that you're buying and what you're paying for. So, but anyway, so companies that have cash, they're investing in debt securities and stock securities. And I think we clicked back to in the PowerPoint's version of this, the equity statement with the initial investment and additional investment and the income and subtracting out the dividends, which is a drawing, or dividend is pretty much the same thing. So again, it's what company comes down. Do they strategically? And again, we had the discussion in the PowerPoint video. If you're a Coca-Cola or Pepsi, do you own the bottlers? You not own the bottlers, and you don't stock in the company, and that kind of a thing. So again, it's at the end of the day, anything that makes your earnings look better and or you have more control over the quality of the bottlers and things of that nature, because that could be another issue where, okay, we're going to farm this out to somebody else, but do we how much control do we have over that? Oh, by the way, also for the folks who answer questions about, you're reading this part of it, not the left hand side, not the right hand side. This is just for me. This is just to remind me what I'm doing, type of thing. So looking at this, why did discussions invest in debt and stock securities? Explain the accounting for debt investments. Explain the accounting for stock investments. What a consolidated financial statement looks like. How are debt and stock investments reported in financial statements? Short-term and long-term investments. So, and what you're really doing is you're expanding what you know. And again, I know you didn't read the first 14 chapters of this book, or the first 13. I just read you read chapter 15, but the first 14 you didn't read. But you should go back at least the first couple. Just give them a quick read about income statements and receivables and payables and how to represent cash, and how to just talk about assets, because it's there's a chapter on receivables, there's a chapter on planned assets, there's a chapter on the cash entry, and all these different things, and those are all broken down into a lot more detail. And how that helps you is as you're modeling a balance sheet, which is a very important part of the financial statements, you'll be comfortable with all the entries. And actually, we have something at the end of probably tonight where it'll be the most entries that you can put on a balance sheet that you would know if you read the first 16 chapters of this book. Now, here's another, and I'm looking at it somewhere on my desk. This textbook is relatively thick. And actually, here it is. All right. So, because obviously we don't see this in class. This is the accounting principles textbook, right? Rather thick thing. There's another one like this, even thicker, and it's called the intermediate version. Okay. So, yeah, that's also out there. So, I don't know. I mean, sure, you're reading those things. It could take half a decade to read those if you're working and raising your kids and doing all the things you're doing. It could take a while to read all that. Okay, so why do corporations invest? Accounting for debt investments, accounting for stock investments, and then the details, less than 20%, between 20 and 50% of all. How much of the company do you own? All the company, kind of a thing. Or you're a parent, or who's a subsidiary? You get into the legal aspect of things. That, folks, like I said, I've mentioned my paralegal background. I remember about a third of the courses, no, third, maybe a quarter, so 25% of the courses. You take 12 courses, 3 of them were corporate corporate law, right? Contracts, intellectual property. I forget, corporate law, contracts, and those are the 3. But it's all the business law book that any law school. The guy taught at the what was the name of it? The one for the Jewish faith, not Hofstra, but probably that one too. Yeshiva, and he taught that law school, and so he used the same book and had the same. He didn't all of a sudden say, "Okay, well, I'm coming to Queens College. It's a different lecture." I don't think he did that. I think he pretty much taught the same material. And then we'll come to class, and we were a little bit older than like his regular students. It's like his students were like you guys. Everybody's like 20, 21, and he would come to Queens College and start complaining about, oh my God, the students did this, the students did that. He had 2. I remember he told us the story. There were these 2 students who. Never came to class but did well, and at least grade wise, but he wasn't going to give them a top grade because they didn't come as much, and it was a big fight between the dean and the president, all these different things, and he sort of fought that fight. They probably were very, folks, let me tell you something. When you do something like that, I've had people who have extraordinary work schedules and really just coming to class would just sort of kill them in a sense. Now, I'm not saying most people should do this, but we arranged it where if you're working all night and you need an extra 3 or 4 hours of sleep, and I would have like an 8 o'clock class. Your next class after mine might have been at 11 or something. Those 2 or 3 hours helps you a lot. In your other classes, I would sort of say, hey, let's work this, and that's where the video helps. Where student athletes, if you're traveling or something, we can, you're not missing anything at all, at least with me. And I've been 100% electronic for a number. It didn't just start with this virus thing. I've been 100% electronic for 3 years now, 3 or 4 years, where it's just everything that I think from 2017, somewhere in 2017, 2018, somewhere in there, I've been just 100%, and that's, and because you can transmit your knowledge a little bit better, working like this. And certainly for you guys at a time like this, it's much better too. Valuing and reporting investments, balance sheet representation, losses and gains. Actually, looking at this, I always like to have the R be capital. So I always like to have my letters sort of stick out a little bit. Escape. Anytime you copy, you highlight something, you can always hit escape. Okay. So that's where we're headed with this. And again, so you have this. I'm going to upload sort of the filled in version. Why corporations invest. We've really had this conversation for a while. But just, again, I try to recreate what the graphic in the book as best I could. As companies do business and people pay them, they have cash. So again, you always want to think, a company that you can really understand easily. Don't try to relate to JP Morgan and what they do for a living. That's not really gonna get you too far. But something like this, where Coca-Cola or even a Walmart, they're selling bags of pretzels and frozen French fries and bottles of milk, and we go to the register, we pay cash for what we do, and someone collects all that cash at whatever part of the day, and brings it to the bank. Basically, is what happens at Walmart, and they have a choice. Should they buy more inventory? Sell more, buy more potatoes, sell more potatoes. People owe you, if it's a credit card, someone basically owes you, but whatever it might be, if there's a check, it takes a couple days for the check to clear until it turns into cash. The Walmart, though, is pretty much a cash business. They want the money right away. They're not extending credit generally. Amazon might be a little bit better, or anything with PayPal. Also, there's generally going to be a 6-month window with no interest, especially if you have a good credit rating like I do. That's going to work for you. Folks, don't burn through your credit at 21 or 22. It's been a long time since I ran into it, but there was a student a number of years ago who got into a lot of trouble. She bought a car, like a Mercedes or something. She was just, she was making like, $80, once a week as a waitress someplace. And she bought a Mercedes and put it on her credit card somehow. And it got repossessed pretty quickly, but it was either Mercedes or but something like that. It was that type of story. And then she came up to me and asked me what to do, like if I had like some sort of personal financial advice for her. And it's not free money in this country. I mean, she's wonderful, really a wonderful girl, wonderful person, but just didn't really understand. That you really couldn't do things like that. So anyway, cash, inventory, receipt, and then the company makes a decision. Are we going to open another Walmart in Kearney, New Jersey, or are we going to invest in play the stock market kind of a thing? And then if you're anybody with a cash account can invest in securities, debt, or stock securities. Okay, anybody can do that. And again, we had all the. This is just text from the book, and you guys can just sort of read through this. Again, the reasons companies invest, generate earnings, kind of a thing. That's third reason, strategic reasons, generate some kind of returns type of thing. That's what this part of it is. It needs, again, short-term, I'm not saying short-term loans, but maybe a short-term gain somewhere. Generate earnings is the second one, and strategic reasons might be the third one. So low risk, high liquid securities. You'll talk to any money manager in New York, and they'll tell you that. So somewhere to store. You want to, instead of just putting the cash in the bank, to store excess cash. Low risk, high. Now again, when you're McDonald's and you've got X dollars type thing that you're just sort of storing, you're getting a better deal than somebody living on North 6th Street in Newark is going to get, walking down to the Wells Fargo by the Burger King down there. You're going to get a better deal than most of us would get. Generate earnings, or again, if you're looking to generate some sort of, as it says, some sort of earnings from your investments. Now, pension fund managers, that's all they do. They own companies and they buy and sell those securities, and they're looking to make a gain as much as they can. That's all that those guys do. They're not in the tire business or the any of those kinds of real asset businesses. Meet a strategic goal. Again, the Pepsi Cola example. If you're a bottler, kind of a thing, and you want some control. Sorry for that noise. If you want some control over your that, and the Amazon and all that, they're same thing. You notice now there's Amazon trucks, there's Amazon vehicles that say Amazon. It's those gray things, they're just a little bit of a more modern look of the vehicle. Sure, UPS still delivers packages. The United States Post Office still delivers packages, and I'm sure you saw that, or but I'm sure Amazon and the Overstock, whatever it is creeping up as a competitor, Walmart.com. they're trying to figure out how to mail things to you. Should you come to the store? Is that better? And I bought that isopropyl alcohol that's supposed to kill the coronavirus if you just not even rubbing it. I think you just touch your hands. It probably kills any viruses. It's $2 a bottle for a 32-ounce bottle of it, right, from Walmart. ShopRite is a little bit more, a couple of cents more. CVS is almost double. CVS like $3. Never buy anything in drugstores if you can avoid it, kind of a thing. But they figured out the best way to, for the weight and the size of all the packages. Is the post office better? Should we deliver it? Should we hand it off to UPS? I buy, suits and shirts. I buy all that stuff from India, and it comes from DHL, and I get it in about 3 weeks. But it comes from India. Pretty much all the shirts I wear, all the suits I wear. When you guys see me in class, they're all tailor made for me. I send them my measurements, and they make one for Enzo, and they put your name in the back inside somewhere. It's really nice. It makes you feel wealthy when you have it. But again, and ordinary people can start living like that. You go to New York for a custom made pair of jeans, it could be $1,000. Kind of a thing. Wrangler or whatever it might be. Was it Levi? No, Levi. I called a number of years ago. They want $1,000 for a custom-made pair of jeans. And that's. But again, you'll see some with the cuffs turned up, and you want to look good when you go out to the world, and that's important. Your look is people judge you on your look and your hair, and that's not mine. No, that's mine. Okay, we're here with this. It's debt investments or investments, okay, and government of corporation bonds. Accounting for debt investments, companies make entries to record the acquisition, the interest revenue, and the sale. Okay, so in the previous chapter, you learned something about debt investments. There's, generally here, just as an example, a 6-month payment. You can either redeem the security, and obviously, you're getting your money back, on whole, or if it's a mortgage type loan, it's just a set of fixed payments, whatever it might be. But there's, a periodic payment, and there's an ending payment, either the same size payment, or it could be like a balloon payment, like people in the field like say a balloon payment. So that's how the cash flow for that works. So Cool Corporation acquires Doan's bonds, $1,000 bonds, 10-year. So again, the bonds are $1,000, but they get them for $54,000, including a brokerage fee. So yeah, I think we may have done some of this math on the just using the on the PowerPoints the other day. So to record so how many of these are we buying? I put 50 here. So I mean, look, if you spend 54,000, you're going to come down here 54,000, 54,000, right? That's what you're going to do, and you don't need this extra zero. So I'm going to change the formatting a bit as I go through this. Yeah, you didn't need you didn't need the extra zero. This was just an entry, but you know what? It's 50 instruments, and I paid 54,000, but I paid 1,000 in fees. So here, let's look at what I really paid. I probably did this on the PowerPoint, isn't it? So I paid 54,123. I subtracted 1,000, right? I subtracted out 1,000, and then parenthesis home, parenthesis 10, divided by 50 of these instruments. Need a black font. There. So each instrument I paid 1,060. So I paid a premium for these $1,000 bonds. Okay, I took out the 1,000 fee. Okay, I had 50 instruments. Right, so it was 53,000 divided by 50 is 1,060. Okay, each. And folks, again, like the Mona Lisa, every time we go through this, I'm sure we're going to be, putting in some better things, better notes and better detail, every time. Okay, I mean, obviously, I've taught this material a lot of times, but this particular chapter and this particular go through, this is the first time we're hitting it, and we're going to use this in the fall also. So we want to have that, we want to have this sort of ready to go. I want to do this. I want to go over this material a couple times, but it's an 8% bond, 10-year term, 1,000, $1,000 units, and then 50 of them, and then what you paid for, kind of a thing. So all this detail. If you're paid 54,000, that's what you got to. So and again, but what happened here, right? You took out cash, you converted it to an instrument. That's what you did. Okay, you took out cash and converted it to an instrument. Is what you did. And then it says we're paying interest semi-annually. So what are you doing with this? And you got to be, you got to go through sort of the thinking of how to get all these sort of worked out the right way. So now the initial transaction happened when you converted your cash to the instrument January 2012, January 1st, 2012. I remember where I was at that time. I remember what I was doing too. So yeah, so it's going to be $50,000. Now that's the face value. Yeah, there were $1,000 bonds, you bought 50 of them. So it's actually a better way to do it is 50 times 1,000 times 8% times 1 to, so it's a half year type thing. Okay, so again, get rid of the decimal place. You don't need all that. Right there. 50 units or instruments, $1,000 face value, 8%, half year. So that's a receipt of interest. So again, that's cool. That company getting that goes, and it's going into cash. That's why it's debit. It goes into cash. And revenue obviously is credit, but still positive. So these all balance. Okay, these all balance. Okay. This I think we're just going to do this again, right? It's just the same thing. I equaled it to that, but here I did this again. I did the math again. No, I get equated to this, right? To this, but I just did it again. Same thing. So now here's the difference, though. Here you're in July 1st, you received the cash. You're closing your books December 31st. Okay, so you're still recognizing the $2,000 revenue cash flow, but it's just a receivable on this day. On the 1st, it's going to be a cash payment. But right now, it's still just simply a receivable. Okay, but on the 1st, it's going to be a cash payment. Okay, the 1st, it's going to be, there it is. And again, I'm getting rid of all those extra decimal places as I go along. Sorry about that. But that's so again, so you record that cash a day later. That matters, that matters, and reports it in other revenues and gains. So it's not revenues from now. If you're Walmart or something, it's other revenues and gains. But if you're JP Morgan, this is your main business. Your revenue, your earnings from interest is a main part of how that's fees. That's a main part of how you make money. Okay, how the firm generates revenues is that way. Okay. A credit to interest revenue because company unaccrued interest in the previous accounting period. Yeah, so right, you're not going to recredit interest, right? Because you recognize this payment once. Okay, this was coming, coming a day later, but it's coming, and then so at this point as a receivable, you're saying, hey, we're expecting this, a day later. So this is how this journal entry will work for that. And then when you convert the cash, you go, you increase your liquidity. You go from an interest receivable, which is pretty liquid, to something that's a lot more liquid cash. So you're not going to do interest revenues twice. You're going to do interest receivables. Okay, again, it's some kind of a receivable, is what that is. Okay. Yeah, here you're selling the bonds. So what's going to happen when you make it? And again, look at what you paid. You paid 54, and what's being said here? What's being said here is bonds for sale. Net proceeds of 58,000. Which are right there, and certainly you can start subtracting things. But here, this debt, what are you're retiring that initial debt investment. That's 54,000. Right? You're retiring that is what you're doing. And then here, obviously, if you sell those instruments for 54, for 58, you bought them for 54, you're looking at a $4,000 gain. This is the sale of the bonds. Okay, so you do it a year later. Okay, you're not waiting for this thing to be retired. Remember, we did the retired example in the previous chapter. You're selling this just a year later. So someone is buying the remaining years, the other 9 years of interest payments for 58,000. And again, the reason it's 58, not 54, you're saying, well, why don't you just sell for what you bought it for? Well, because somebody did some sort of time value of money computation with an assumed um, discount factor or an assumed opportunity cost, and say, okay, we can live with another 4,000, or otherwise we probably just keep them, type thing, because we have another opportunity where we think we're going to do better than how we're doing with these debt investments. Okay, that's really that's why these kinds of things happen. But again, that's the economics. Okay, like I said, I'm just showing you from the accounting perspective what's going on. But this is, we're talking economics here is what we're talking about. And again, other revenues and gains, other expenses, and if there's a loss, it's other expenses and losses. Yeah, this is a little bit longer. This is pretty much the same thing, but let's just again, these are tricky, so I want to just, go through them as best we can here. And again, you're just going through all the transactions and what happened. 30 instruments, $1,000 each. 10% bonds, you bought them for 30,000. You bought them for face value, and then another 900 brokerage. So what did you spend? You spent 30,000. It says you spent 30,000, right? So it's 30 times 1,000 plus 900, because you spent that to execute the transaction. Okay. That's what you did. So the purchase of 30 Hillary bonds by Waldo Corporation. Obviously, I'm sure it's a play on Hillary Clinton. Sure, she was around when this book was written. She's been around since the 1990s. She was considered around in Arkansas long ago, before Bill, in the 80s. Right? She was considered around. She was considered a big political player at that time. Type of a thing. So you converted cash to these instruments. That was the first part of this. And it says transactions, journalized transactions, prepare the adjusting entry. So this is the first thing that happened. And again, you have a note here. It says interest payable July 1st and January 1st. Okay. You received the semi-annual interest payment, and then you sold the bonds within 6 months, or you sold half of them. And we're going to look at, for 50. Now you bought them for 30,000. Well, and here you have to be careful. You bought them for 1,000, but you also bought them for half that 900, and then another 400 here in fees. So it's not just half. There's a little extra, and you got to deal with you got to deal with the extra, and that's what we're going to be dealing with now. So you record the bond investment at cost. We did that. Interest received and or accrued. We're going to talk about that. When bonds are sold, credit the investments account for the cost of the bonds. Okay, because you're selling. It's an asset that you're selling. Pardon me. And then record the differences as gains or losses. So we recorded the sale of these things, and we went through the math here. There's the math: 30 instruments plus a fee. So for you to buy those 30 instruments was 30,900, because you had to spend a fee to do it. Now this is just simply the interest payments, and this is going to be equals 30 times 1,000 times 10%. Excuse me for yawning. Times a half. 1,500. Which is right there. That's the first interest revenue that you have, and that goes into to whatever the company is. It goes into Waldo Corporation's cash account. Right? They're the recipient. They're the beneficiary of the interest revenue. Now here's a sale, and it's just 6 months later you sold part of them or half of them. Yeah, we did some of the math here. What did we do here? Yeah, buying fee, selling fee. So we put it all in the note. If you see that little note, what's going on with this? So what's happening here? You did, or you had, yeah, the loss is just simply the difference. Okay, the loss is just simply that's all that is. So again, whose perspective? So from Waldo Corporation, they received 15,000 minus 400. Okay, that's what they did. All right. So here equals 15, 1, 2, 3 minus 400. Okay, that's what they received. That's the first thing for half of these instruments. Now here's the drum roll on all this. We accounted for that payment or the fee for selling. Kind of again, you buy, you sell. There's a fee. So even though you receive 15,000 from the buyer, but there was still a fee involved in the bank because there's an intermediary involved in this. You had to pay them 400 to execute the transaction. You're selling half of these things, right? You're selling half of your instruments. So you're selling equals. You're selling 15 out of 30. You paid 30,900, right? So that's how you got the 15,450. Okay, that's how that happened. Okay, it's basically just half of what you, not half of 30,000, but half of 30,000 plus that fee is what you sold. Or that's your when you write that down, you have to write down because the fee was a part of it, so you're writing it down half, including the fee. So 450 plus the 15,000, which is really what, half of 900 is 450. So you receive this cash, you're writing this off. So for better or worse, you're looking at a, and you need to manipulate this. You're looking at a loss because there's no negatives in the journal entries. Okay, old age 9. Okay, but there you go. That's your loss, and that's going to be on the equity side. So equity side losses are debits. Again, apologies for the yawn. That's your 850. It's just the difference in what you're writing off your asset, and unfortunately for what you're selling half of it, including and again, when you have a fee, you want to make the fee back and all that, and so you bought in for 15,450 for these 15 instruments, but you sold for 14,600. Okay, so it's a loss of 850. All right. And now what's going on, you got to be careful with this. You only have a half of the bonds, right? You only have 15 of them instead of 30. See how that is $15,000 in bonds, 10% interest, half. That's 750. Okay. That's the accrual. That cash will show up in January of 2013 for Doning. Okay. So again, you got to view this video a couple times. You got to view the video a few times. This is stock investments is next. Yeah, you have a couple pieces here. So this goes up to about 300 or so. Capital stock for the companies. Okay. So now look, you're buying an instrument or you can making an equity investment in a company. This particular one, you're distinguishing between a portfolio, securities in a portfolio, and an actual, capital investment in a company. Okay, those are different things. You're buying the right to the earnings, is what you're doing when you buy stock, or the dividends. Dividends, earnings, that's all pretty much the same thing. So, extend the earnings influence. Yeah, and also, how many shares. Now again, I'm in the strata where I don't buy 1,000 shares of something. I generally get paid in stock, and it's usually a bunch of shares. It's not 1,000 or 10,000 or something like that, or 100. It's a pretty good number. And I have to say, hey, how much of this? Usually, I'm believing. It sounds like say, oh, I got a couple 100,000 shares or something. That sounds like a lot, and it is. I'm not saying it's not, but also as relative to everything else, though, it's usually just a couple percent, and that's how, private. I'm at a level where I could say, hey, just pay me the stock, and hopefully this venture works out, and I'm okay with that. But that you can't do that at 25. But I can do it. So anyway, so looking at this, representation on the board. I don't, but I'm influential because I help put these deals together. Does the investor participate in the investor's policy-making process? Sure. Material transactions between the investor and the investee? Sure. Okay, so, but again, these are legal questions. It's cloudy, but the real answers to this is how many shares you have, and then everything else, kind of a thing. And then, the accountant, the attorney got to make a decision as to how we're going to classify your investment. If you make a mistake with this, it can be a problem. Okay, it can be a real problem. So just keep that in mind. Some of the guidelines, investors is just, you're just buying common stock with 20%, influence not that big, cost method. Okay, that the accounting guideline for that. Equity method is between 20 and 50%. You have significant influence on the what you're investing in, and then the third piece, more than 50%, it's a controlling interest, and you're looking at consolidated financial statements. I looked up the New York Mets because it's been in the news that Alex Rodriguez and Jennifer Lopez want to buy into it. I thought Alex Rodriguez was a minority owner in the Mets already, because a lot that happens with a lot of these guys. That they own a little bit, and they get to know everybody. They're invited to the meetings and say, "Oh yeah, we like this, and we want to buy more." And yeah, I mean, Alex Rodriguez and I are close in age, but I remember, the mid '80s. The mid '80s, the Yankees weren't that great, and baseball, you didn't have baseball where everybody sort of, it's getting to the point where everybody sort of makes the playoffs now. It's like hockey, but there's a lot more playoff teams. Back then, the Yankees had a lot of good years in the baseball team had a lot of good years in the 1980s and did make the playoffs a lot. Outside of '81 when they were in the World Series and lost to the Dodgers. I don't think the Yankees were in the playoffs until 1995 again. I don't think, but they had some good years there. Ricky Henderson, it just because and they were a couple games short and this and that, and Boston had great years, and Baltimore was a force. Detroit in the middle, in the mid 1980s, they were quite a force. At the end, Oakland had a mini dynasty run that mirrored the early 70s. Oakland, the late 1980s with Canseco and Mark McGwire and some good pitchers, and that was they put it together very well. Those are some the late, like 87 to like 92 in Oakland. Those are some very good years. They put it together the right way, and Dave Stewart was on there. They got a bunch of people. They caught lightning in a bottle about 4, 5, 6 times. When you get the right pitcher at the right time, the right couple hitters at the right time, they had a good young catcher, and you do all that, then you sort of Oakland is a fine organization, but just they're in a part of the country, even though it's California. They're not Los Angeles, they're not Chicago. They can support 2 teams. California has 5 teams, right? San Diego is the Padres, Dodgers, Giants, which are up northern. The middle is the Anaheim, which is we're struggling. Is that Los Angeles? Is it Anaheim? It's somewhere in Orange County, right? It's the Orange County version of baseball, and then you have the 2 northern teams, and then you have Seattle, and Arizona's got a team now. So, it's for whatever reason I can't recall being to Oakland. I probably was there, I just don't remember. But again, it's kind of like Newark in a sense, where it suffers from the ills of sort of being an inner city and problems. And the Raiders left, a couple times, or the football team left. So when you see that, that's not great. When well managed team, good team. Remember Brad Pitt? He played the Moneyball. He played the general manager. He played Billy Bean. But it's California. You live in California. It's beautiful, right? So you sort of live with it, kind of thing. But again, hey, Yankee Stadium in the Bronx. I've been there since I was a kid, but it's not. I would never say that. Hey, I should go live by the Yankee Stadium. I don't really feel that way. It's very crammed. It's very crowded. It's not easy to park or move around. It's congested. It's very congested area. So I can see why people say, hey, we want to live in Northern California, and people would sort of put up with things that I can see. Common stock, preferred stock, and who gets paid when, and when companies liquidate, who's in line first. That's a whole issue. That's really a whole issue. Cost method. So some of these should be bolded out a little bit, I think. cost and recognize revenue on cash dividend, and that's sort of the kind that we're used to is the cost method. Yeah, stock investments, cash, recording the dividends, type of thing. This should say cost method, but it doesn't. So now the next one is equity method, equity method. Yeah, and we'll get to that. Actually, so here there should be maybe a little divider or something. I should put something in there just to sort of wake us up to what we're doing here. Now we're equity. This is stuff that we're used to: cash, investments, loss, all that revenue. This is sort of the kind of stock investment, which is another asset. This is all the accounting that we're used to. Like I said, when we're going to hit this. This is the less than 20%. This is the cost method. This is the less than 20% version of this. So it's, Sanchez acquires 1,000 shares, so it owns 10% of Beal Corporation, and it pays $40 a share plus a brokerage fee. And we're going to go through, all the pieces to that next. Why isn't this? Yeah, this should be figured out. I don't know why it's not, but I'm going to figure it out right now for you. So this equals 10%, right, times 1,000 times 40 plus 500. Yeah. Let's go through what the professor did. So you're buying 10% of the acquires 1,000 shares. It's 10,000. Yeah, there it is. So it's 10%. So there's 10,000 shares in Beal Corporation. Sanchez buys 10% of them, which is 1,000 shares. 10% of that is 1,000 shares. And $40 a share, that's what you're buying it at. And then you have a fee, attorney's fees, transaction fees is 500. So when you start selling pieces of this, you're also selling the part of your expense was your transaction fees, and you want to recoup that is what you want to do. So this is July 1st. Again, make sure your dates are correct and make sure your little notes are correct and who bought what. Okay, so again, this is, folks, I'm teaching you detailed business. Detailed business, detailed business, detailed business. That's what I'm teaching you. Okay. Recording the dividends is the next piece of the puzzle here. So what do you have here? You have what? You have 1,000 shares. What's the dividend on this? Oh, $2 dividend. The number of shares that you have, so equals $2 times 1,000 shares. Okay, so again, there's 1,000 shares that Beal Corporation Sanchez buys from Beal. Okay, and that's how they get their dividend revenue. Again, this is the cost method, is what this is. It's the kind that you're used to. I'll say it like that. That's what the kind that you're used to so far. And again, other revenues and gains. It's just another revenue section. Okay, and the dividends. At this point, for the cash dividend, this is not accruing. Okay, so there's no adjusting entry that's going to be made. This last piece of this, before we get to the other examples here. Yeah, more than 50% is consolidated. That's just simply consolidated financial statements is what that is, and we'll get to that. We'll get to that. So you have the initial transaction. You have the cash and the dividend revenue that you have. What are you doing next? So, okay, they're selling all the shares. Okay, they're selling all the shares is what they're doing. They paid in $40,500. They're selling it for, their cash number is going to be the 39,500. And then you're going to do what you bought this for. If you're doing the whole thing, it's generally pretty easy. It's just you have to do ratios or anything like that. Okay. And this is the difference, and it's a loss. For better or worse, it's a loss. Yeah, that's it. Yeah, this is other expenses and losses in the income statement, and we have that somewhere. I forget where we had that. We showed that actually here. Let me see if I can quickly find it for you. I know there was a bigger sort of income statement somewhere along the way here. Equity statement. Oh yeah, this is all. These are all the depreciation methods here, so it may not be that. Is it under receivables? But somewhere it showed something. A very sort of sophisticated income statement someplace. These are partials. I apologize, folks, if I can't find it, but I know it's in here someplace. Maybe it's under accounting inventories, maybe. It was at the end. Okay, all of this stuff is generally at the end. And it's not here. Yeah, this again, this is the inventory section. I didn't teach this section. It's under merchandising. Yeah, here it is. Or at least it's a little. Yeah, see other. Yeah, there it is. Non-operating activities. There we go. Like I knew it was here someplace. But see, that's what it looks like. That's the income statement part of it. And you see interest revenues, and these things just sort of entered in here. But now you have a better idea. Gain on disposal of assets, interest expense, casualties from vandalism. I'm trying to think. Did I teach this section? I think I did. Yeah, I taught this a couple springs ago. That's what I remember. So, but yeah, and you can see a little bit of an expanded balance sheet, which is here, a bit of an expanded balance sheet. Okay. It is right there. So control page up all the way to. Okay, so that's what we're looking at there. Other expenses and losses and all that. Okay, but that's it. So yeah, so this is cost method. Okay, this is now this is equity method, which is the next method. Yeah, so this is again, a different percentage. This is next level guy might own 20, 30, 25%, 35%, 45%. The company. You have some influence when you're that much of an owner, and that's in the private world. There's no such thing as we're not going to tell you what's going on, kind of a thing. If there's no disclosure, there's no deal, and if you start hiding things, you're really the private equity world is dramatically different than public pension funds and all that stuff. The private equity part of things. There's a lot of lawsuits, and you never know who you're dealing with, and that's there's a danger to it. There's a real danger to it. So yeah, the equity method, the investor company initially records the investment in common stock at cost. Adjusting the investment annually shows the investor equity in the equity in the investee. Increases or debits the investment account and increases or credits the revenue for shares of the net income. Decreases account and dividends received. Fine, because you own that company, and then you're sort of taking it from one account and putting it in another is really what you're doing. And the investment account is reduced for dividends received because payment of dividends decreases the assets of the investee, which is what you're investing in. Right, but again, that's always better illustrated with an example. Loss kind of a thing, and share the investee's loss, and again, we'll get to all that. But again, examples are always the better way to hit this. So Miller buys 30% of Beck for 120,000. Okay. Beck comments by Miller Corporation. Fine. Okay, we did that. Next one is the company purchases Beck's. Yeah. So the company Beck is as a whole 100,000 net income. It pays 40,000 cash. Retained earnings is 60. So whatever, or if there was no dividends, retained earnings would be 100 type thing. So if there's a 30% ownership, then someone's got to get 30% of that 100,000. And then and notice how how this is, it's revenue from stock investment in the equity method as opposed to dividend revenue and cash as opposed to that. The first one is just you own shares of IBM or something, or just some very common stock that's out there. So okay, so looking at this, you have a couple computations. Actually, there's two computations to make here. So this is, I always like to work in the slot of this that sort of makes the most sense. We're here. So, and again, whose books? This what is it? Sanchez, Miller. These are Miller's books. Okay, so Miller's going to get 100, 1, 2, 3 times 30%, which is there. All right, that's revenue from the stock investment. And what you do is you've increased, you're part of that business. You've increased your retained earnings 30,000 more. Okay, you have a third of the income. Okay, so what you've done is you've appreciated this from 120, so you converted cash into the shares, into your rights for the income, and that's how the guy who started Home Depot. That's how they're was wealthy. That's why they're wealthy enough to buy the Atlanta Falcons. Kind of a thing. So that's really what's going on here. So that, again, very quickly, you've returned what is that? You've returned 25%. In whatever in a year. That's this world, and it's the numbers bear it out. And again, the better you know the numbers, the better you can navigate what's going on in these different worlds. Now, for better or worse, with the stock, now you're converting is what you're doing. You're saying, okay, we have an asset, and that asset's worth 150,000, but I'm required to pay. What am I required to pay? I'm paying. I have a $40,000 dividend. Right, and I'm paying 30% of that. Okay, that's what that looks like. 12,000. Okay, it's a third of the 40,000, and we set it here. We set it here. Okay, and now we're going to go to the ledger, which is always the far more important piece of the puzzle. This is revenue from stock investments, 30,000. This your initial investment was 120. And again, I don't know why I typed it in like that. I should just refer to it like this. Your initial investment is 120. All right, you're there. So that, again, the balance is 120. And then you have an adjusting entry. And I was saying this in words, right? You were up 30,000, and this from your percentage of the earnings. And this is the conversion out of the investment and into cash. It just goes to another account. Is really what happens to it. Okay, that's how you get 138,000. Your book value of your investment. That's your book value of your investment. Okay. And we discussed this. What happened here? It says net during the year the net was 18,000. Is it above 30? Yeah. So the difference, yeah, it's 30 minus 12 is that 18,000. Share the income, decrease the dividend. It just goes to a different account. Revenue, percentages, that's all that. Okay. This is the equity method. Okay, this is the equity method. And it says, yeah, the revenue reported, this is 30. What was the other version of this? This was 2. This was just simply the dividend. And we didn't even talk here. We didn't even talk net income. Okay, so that was the cost method. We didn't even talk net income here, because all you're entitled to was the dividend in this way of doing this, or this under this classification. That's all you're entitled to, is that. But that's the deal you make, based on the percentages. Okay. Yeah, this is a nice one. It says the parent has 3 wholly owned subsidiaries. They're sourced separate legal entities. From the viewpoint of the shareholders, there's only one. So yeah. So look, if PepsiCo has 3 different bottles, they own the trucks, the bottling, and whatever, something else that they need to run their company. What do they need? The bottling, maybe the labeling, maybe the label making company or the packaging company. They own that too. So they own the package making company, they own the bottling company, and they own the trucks to deliver. Those are 3 subsidiaries, and if a truck runs you over, you're not suing Coke, you're suing the subsidiary type thing. And that's there's a legal component to all this. There's no, if you're going to be in business, there's no getting around that. There just isn't. So, and this is holdings of more than 50% type thing. All right, save as you go. Yeah. So if the parent, if you own more than 50%, there's a subsidiary, but if you own more than 50%, you're considered the parent. And again, now we're getting into the legal avenue here. More than 50% of the common stock, it prepares consolidated financial statements. Okay. So all the assets, liabilities are added up together, all the revenues, expenses. It's again consolidated, and then it has some examples: AT&T and Turner, and all that. Okay. Yeah, I was trying to figure out if we were going to just go with this. So we're there, and now we have valuations, which this is some work to do, and this is balance sheet. Okay, and this is comprehensive. We're approaching an hour here, so you have the consolidated version, you have the cost method, the equity method that we just looked at. Now you have this other, which made a little bit of a long problem here, but there's a couple pieces to it. But let's certainly let's finish this, and then we might. I said we would do one big long one. We could, but I think it's just I've just learned that it's just better to do these things and do pieces of these as we go along. And the investor has little influence over the investee. So maybe Sunday you'll get the other part of this, and you're going to get you have the self-test coming, you have the comprehensive problem coming, so you have a couple more pieces to this. So little influence, owns less than 20%. Another company, net income earned is not considered a proper case for recognizing income from the U.S. By the investor. Okay, so Yeah, actually, these are two different cases. You want to prepare the journal entries, and there's two separate ones here. So the first one is presume the investor has little influence over the investee and the investor owns less than 20%. And then income earned by the investee is not considered a proper basis for recognizing income from the investment, but to the investor. Okay, and then the other one is your 20 to 50%, and then you're using the equity method. So this is cost method, and the other one is equity method. Okay. And we should type that here. All right, those are the two methods. Underline this. Here's your two companies. So Row Jeans is the first one. Okay, we'll look at the entries that are involved in this one. So these are two separate sets of journal entries you're making, two separate sets of analysis. Row acquires 5% of Stillwater of the 40,000 shares. It's total $6 a share. There's a dividend that's paid, and there's some income. Okay, net income. Yeah, and we're going to look at all the different pieces to this as we go along. So this is going to be equals 403 times 5% times $6. Right, that's 120. Right, 120. And they're purchasing, yeah, that's 20,000 shares by Row Jeans. Okay. And now the dividend, so you own 5% of this company equals 5% times 5, 1, 2, 3, Alt H, 9. All right, that's 3,750. Copy this thing equals this 3,750. And the dates, you have the right dates here. August 30th. Okay, and then the income was reported, but again, when you're under whatever it is, under was it less than 20? I think it was less than 20. It's between 20 and 50. Yeah, less than 20. Yeah, when you're less than 20, you're not entitled. Legally you're not entitled to that, to the cut of the income. It's not. That's not how it's computed. You just dividend and that's it. So now the equity method is next, certainly. And this is going to be Debbie obtained significant influence over North sales, 40% of the shares of 60,000 shares outstanding at a cost of $12 a share. Okay, and we're going to hit that. Okay, so how we did all that. So, yeah, 40,000 or 24,000, so equals 40% times 60, 1, 2, 3 times 12. It's 288. Right there. So about 24,000 shares right there. On the 1st of January, a dividend was paid. There's some income. Now, again, you're in the equity version of this. So again, look at how this is. You're writing off your asset by the dividend that you're entitled to 40% of it. So equals 40% times dividend is 45. 1, 2, 3. Right, that's 18. All right, that's record the dividend received. So you write down the asset, but it's your cash. So again, it's looking at Debbie's income statement. So that, I mean, look, if it's one asset or another, as long as my assets add up to the right number, I'm good with that. Okay, that's the recorded dividend received. And yeah, but the revenue now equals 40 times 120, 1, 2, 3. You're looking at 48,000. So they're entitled to 48%. which is there. Okay. That's it. Okay, so we had equity method and cost method. Okay, so we illustrated both of those. So we did 3 of those. More than 50%, which is the next section, between 20 and 50, and then less than 50. This is a lot for a video, and we have the debt investments. We had those. So there was a lot of entries here. So this was about an hour. So I'm looking to now. I could just keep going, but valuing these things. So again, I want to give you a breather with the video. So I want to really give you a breather with these videos. So we're going to pick this up now. Tomorrow's is going to be, or tomorrow Sunday, available for sale, trading, what this all looks like, and how you change the or how you make the adjusting entries. This is the balance sheet presentation, which is going to be kind of long. So I want to spend some time on that, and we'll see. There's a comprehensive problem here, which is might be a good sort of review, and then maybe we can have one video that just does a self-test and just those 13. Like I said, I could just do everything in one video, but also I want to give you guys a little bit of space. We hit an hour right now, so I think we're generally pretty good with this. So yeah, so like I said, let me upload this to Blackboard, and like I said, you can get through this video. You can watch it end to end. The equity method, the cost method, and then we'll have another hour video. One more time where we should just sort of review what's going on with all this. Okay, so let's make sure we save this, save everything, save that, save this. Okay, so we stopped sharing for those. So yeah, this was about an hour today. Like I said, let's try to keep these things up. There's another hour with the next one. Okay, sorry. Let's get this the process going with this, and folks, we'll see you next time.